Oh, it's gonna be right there. You cannot stick it in the ground. It's not gonna work.
Who did that?
You gotta put it in the shoe.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, hit that subscribe button as well as the notification bell. Hit the like button too and leave a comment for the algorithm. It really helps me out. Let's get into it. This is the daily heat map of the S&P 500 and today's day was pretty much exactly like every other day so far this week. A very mixed day. Gainers in cyclical sectors, tech getting sold off as the rotation continues. But there's also a bit of anxiety. We had Nvidia's earnings after the bell, same with CRM, same with CRM, as well as CrowdStrike. So big players from each of the technology subsectors. That's why tech was grinding and digesting in today's trade. However, we saw outperformance here in financials as well as healthcare, and then utilities were also quite green. Certain sectors of industrials were green, others were very mixed, and then the rest of the market was kind of red. It was a very average day, a day of pure digestion. Financials, healthcare, utilities outperformed, but nothing to write home about. And then tech and discretionary really weighing on the entire market, down 1% and 0.8% respectively, along with energy, communication services down 0.6, 0.4%. And this is really why the broader market actually lost today. The S&P 500 fell negative 0.6%. The Dow Jones and the RSP were the best performing sectors, up 0.28, 0.39 respectively. The worst performing was the Qs, the Nasdaq 100, down more than 100 basis points here today. We did see a huge move off the lows around 1 p.m. in all sectors, especially in the Nasdaq 100. Things got a bit oversold here, especially on an intraday basis, but it was selling across the factor spectrum. Growth, core, and value in large, small, and mid caps really took it on the chin. I mean, excluding large value, which is like, utilities and financials, really, they were pretty much flat on the day. Every other sector was down big, especially growth. Not a fun day for growth assets. Large growth down negative 1.26%, small growth down 1%. Mid caps actually faring the best, and mid caps have actually performed the best so far this week. It's very interesting because in the community poll, people were least bullish on mid caps, and yes, we are in a red week here for the broad market, but mid caps outperforming respectively. But regardless of size, value outperformed, and value really did produce alpha in the market today, at least relative to the downside. But today's trade was really just isolated in North America. The US and Canada were pretty red, but Europe was actually fairly green. Same too with South America. China continues to be a dumpster fire, but it's 2024, what's new? The rest of Asia was really green as well. The global market not quite seeing the same selling, excluding China, that the US saw today. That's a good thing. You do want the broadening out to not just be in large, mids, and smalls in the US. You do want to see the global market broaden out as well, and that's very healthy. But let's hop on the charts. And looking at the charts, the first thing that we want to look at is what's happening in the extended hours right here, because we had Nvidia report its earnings, Salesforce, as well as CrowdStrike. Now, if you go to the timestamps link below, you can actually just go to my overview of what I think about earnings, Nvidia, CrowdStrike, Salesforce. But we can see that we are seeing a little bit of weakness here in the Qs, down 0.74% in the after hours, in the context of being down 1.13%. So, in aggregate, a very poor day for the technology space, the Nasdaq 100. The IWM virtually flat, same with the RSP. Again, so the broader market not really seeing the same type of weakness that we are seeing in technology. And to be honest, I think a lot of the losses in the Qs is actually offset by stuff like CrowdStrike, like Salesforce. They actually did produce great earnings, and to be honest, Nvidia's earnings were great. Record revenue, double beat, $50 billion in buybacks, margins actually held in there. That was the story of today. We didn't hear much on Blackwell, and I think that's part of the reason why the market sold off on Nvidia. But I think the market is probably gonna find a bottom in Nvidia's earnings, to be honest. We saw a 5.6% surprise here in earnings, a 4% surprise on the revenue side, $30 billion worth of revenue. In my personal opinion, I think that the market is gonna find a bottom in Nvidia over the next couple of days, and then we're probably gonna go to all-time highs. I think these earnings warrant Nvidia going to all-time highs. In my personal opinions, I just think that the reaction today was just a bit overdue, but these earnings were constructive for the market in aggregate. But moving away from Nvidia's earnings, looking at what actually happened in the yield yield complex, yields were very, very mixed. The 2-year yield was actually down here today, 0.87%. The 10-year yield up 0.44%, and the 30-year yield was up 0.29%. As a result, bonds did fall. But what really weakened the overall US market here today was not actually the yields picture. It actually had to do with the dollar. The dollar gained half a percentage point, and it has been a little bit of a dumpster fire here in the last month or so. The dollar weakness is part of the reason why risk assets at the start of August have actually rallied. You know, a weaker dollar is really good for large caps and really good for companies with international revenues. The dollar has been a bit of a dumpster fire, but I think we're going to see a little bit of reprieve here over the next couple of days, maybe even the next couple of weeks. The market can't just consistently go down, or go up. There is ebbs and flows, as you can see right here. We're due for a little bit of a bounce. I do see continued dollar weakness looking longer term, 6 months, 12 months down the line, but in the here and now, we should see a little bit of dollar strength in the next couple of weeks. Looking at gold and the commodity complex, gold was down 0.89%. Silver, a bit of a dumpster fire, down 2.82%, and the crude was down 1.34%. Let's actually dive into the S&P 500. And guys, I feel like a broken record. Nothing has really changed when it comes to the gamma situation. We're still at 5450 with support 5700 call resistance, gamma flip at 5550. You can actually see that here at the gamma flip, buyers came in a very big way. If we just pull up the 5-minute chart, we saw lower lows, lower highs until we actually formed a bottom right here, and then we actually rallied circa 2 p.m. and then we actually went and broke some of these highs. Now we didn't close above them, but we did have price action above, and that's very, very constructive, all things considered. The S&P 500 is just digesting gains. I still think as long as we're above the 550 region, we still go tackle the 5700 area. But if we do start to have price action below here, I think the algos and the sellers are going to come in a very big way, and I think we're going to go to 5450 very, very quickly. So the bulls are in a very critical position. They need to hold this line right here at the 5550 area, because if they don't, we're going to break and go down. But if they do, it's 5750 all the way. A lot of this is going to depend on, yes, Nvidia's earnings, how the Mag 7 reacts to Nvidia's earnings, as well as the dollar. You guys have to be watching the dollar right now, because if it is going to make a move, let's say back to the 103, 104 region, like up here at these highs, and that's going to coincide with large cap and mid cap weakness. Not so much small caps. Small caps are more dependent on the rate complex, and we do know rate cuts are coming, but a lot of them have been priced in already, because when you look at the 10-year yield, sitting at 3.83%, 2-year yield 3.86%, and the 2-year 10-year yield is so close to uninverting, and that ultimately is going to benefit small caps. Now the IWM, I'm constructively bullish on the IWM as long as we're above this 210 area. I think we could pull back, find support here, and then go, but it does get a little bit ugly below the 210, because we could then bring these lows back into play, and you don't really want that. What you really want to see is support at the 210 or anywhere before that, and then make a move higher, break these highs. That would signal trend continuation in what has been a very choppy and range bound year, but still positive, all things considered. The Qs, the Nasdaq 100 looking a little bit sick. It's getting really ugly now. The Qs are down 1% here in extended hours, nearly, that's 2.1% down for the day. That's really ugly price action, very poor performance. I'm actually bullish. I thought Nvidia's earnings was actually good. I thought the earnings was good. The guidance was all right. The guidance came in line. It actually was a tiny bit of a raise, having looked at it again, but I think we're probably going to see some mega cap weakness into this weekend, into Labor Day. And the RSP chart still looks really, really good. Yesterday we said we target the 177 area as our support zone, and nothing has changed since. If we pull back and find support at this 177 area, we can then continue the move higher, break these highs for trend continuation. And that's really what we're looking for in the RSP and the IWM. We're looking to find a low and then continue the trend that we've built upon. Whereas the Qs need to go figure out what they want to be when they grow up. And the S&P 500, as long as we're above positive gamma, we're buying dips, selling rips. But a lot of the weakness that we're seeing in tech stocks is going to flow into stuff like the S&P 500 down 0.61% right now. So we're going to see what that's going to look like in tomorrow's trade. And do take into consideration that heading into Labor Day, we are in a seasonally weak period. So expect volatility, and even more so if we break the gamma flip zone here in the S&P 500. Diving into sentiment, this is CNN's Fear and Greed Index. Very interesting. We're here in the neutral zone, looking like we're about to push into greed, but we're going to see what's going to happen over the next couple of weeks. I think this indicator is going to be more dependent on the economic data. Now that Nvidia is officially behind us, and we go back to trading off the macro and trading off the technical, with the fundamental picture taking a back seat. And we do have the Labor Day weekend next week, and these are the returns the week before the Labor Day weekend. You can actually see that Wednesday before Labor Day tends to be very bullish across the board in the Dow Jones, the S&P 500, the Nasdaq 100, as well as small caps, with small caps being the most bullish. But then we actually get subpar returns on Thursday as well as Friday across all of the indices. But let's just look at the S&P 500. You can see that Thursday returns 0.05%, pretty much flat, and then negative 0.09%, pretty much flat, a slight red day. In aggregate, the week is actually normally green. However, do expect choppiness and volatility over the next couple of days. The hit rates, 57.1%, tend to be very poor across the board. So guys, if we do get volatility heading into this long weekend, a little bit of de-risking, a little bit of profit taking, a little bit of hedging. If we do get that activity into the weekend, don't be surprised. Seasonally, that is what normally happens. So let's talk about earnings. We had a pretty big day of earnings. CrowdStrike actually reported a double beat. They beat on EPS, beat on sales. They were up like 2-3% in the pre-market. The market really liked their results, but still way down from their all-time highs. CRM also dropped their earnings, and great earnings as well. Same thing, a double beat on EPS, beat on sales handily. They were up 2-3% as well, maybe 4%. Really good earnings. Now Nvidia reported a double beat. They beat on EPS, beat on sales. Expectations going into this was about 28.7 billion. Sales came in at about 30 billion. Earnings per share came in at 68 cents versus 64 cents. But the big thing was actually guidance, and I'm going to read something directly from the earnings report. Outlook for the third quarter fiscal 2025 is as follows. Revenue expected to be 32.5 billion plus or minus 2%. That would represent a 75% growth year over year for the quarter. GAAP and non-GAAP gross margins are expected to be 74.4 and 75% respectively. Very high margins still, plus or minus 50 basis points. For the full year, gross margins are expected to be in the mid 70s. GAAP and non-GAAP operating expenses are expected to be approximately 4.3 billion and 3 billion respectively. Full year operating expenses are expected to grow in the mid to upper 40% range. GAAP and non-GAAP other income and expenses are expected to be an income of approximately 350 million, excluding gains and losses from non-affiliated investments and publicly held equity securities. GAAP and non-GAAP tax rates are expected to be 17% plus or minus 1%, excluding any discrete items. So guidance still looking solid. No guidance raise. I think this was the guidance that the street actually expected. Margins held in there. The stock was actually down about 6% on its initial reaction. It's down about 2% right now. So you can definitely tell that these earnings met the street's expectations, but a lot was already priced in, and that's why we're seeing a little bit of after hours weakness. Nonetheless, the fundamental picture remains intact for Nvidia, and what Nvidia does on its initial earnings reaction is generally what the market will do. Nvidia earnings have been a key driver of broad market performance in the short term. This is Nvidia's reactions to earnings, and it's highly correlated with the market's performance over the next 2 weeks. You can see that when Nvidia has a huge reaction after earnings, the broader market in the subsequent week gains as well, likely. But when Nvidia has a terrible reaction, so goes the broader market as well. So with this initial reactions, it could spell a bit of volatility for the broader market into the next week. But regardless of what Nvidia does over the next week, I think the broader market is going to be okay, because we are seeing clear signs of a broadening out. Since the 1st of July, the RSP has clearly outperformed the Nasdaq 100, and stocks outperforming the S&P 500 is at the highest level in 2 years. And historically, right now, the S&P 500 equal weight trades at a near record discount to the market cap weighted S&P 500. And this is part of the reason why the market is broadening out. Excluding the Mag 7, the S&P 500 looks very attractive for longer term gains. And we're also going into a cutting cycle. And at the end of the day, easing cycles have an outsized impact on smaller companies, smalls and mid caps, simply because there's just more unprofitable companies in those indices. 44% of small cap companies are unprofitable, 19% are unprofitable in the mid cap space, and only 7% of large cap companies, pretty much S&P 500 companies, are unprofitable. And this is on a pro forma EPS basis. But a rising tide lifts all boats, and equities tend to perform very well after cutting cycles when economic growth is robust. In other words, when we don't have a recession, and 12 months, 18 months later, we can see returns of up to 20 to 40% in the S&P 500. However, if a recession is to follow, we could actually see pretty deep drawdowns, only getting back to even around 2 years, 24 months later. However, we do know we're not going into recession, and the reason why the Fed are cutting rates is actually to decrease the real cost of capital. This is the real Fed funds rate, which is the Fed funds rate minus core PCE, or the inflation rate. The real cost of capital right now is 2.87%. The Fed want this in the 0 to 1% range. This right here is too tight, and in similar scenarios like in 2019 and in 2023, when the Fed funds rate is too tight, we get outsized returns because the Fed cuts rate 12 months later, 16% returns and 28% returns respectively. But when the Fed funds rate is too easy, like it was in 2021, 2022, you can actually see very subpar returns 12 months later, -9%, -5% respectively. And diving into the macro, we got Goldman Sachs' latest GDP tracking estimate. This is after last week's data, and they increased their third quarter tracking estimate by 0.1 to 2.5% quarter over quarter annualized. Very strong GDP. We always want in between 2 to 3%. We're sitting smack bang in the middle. And while the consensus estimates are looking at 1.5%, Goldman are seeing stuff in their books that's contradicting that fact. And I think they're looking at stuff like tax receipts. August tax receipts are looking very, very strong. If you go to my videos and look 3 uploads ago, I showed you the August tax receipts. It was sitting at 5.5%. We've now jumped up to 6.5% growth in the month of August. The only negative month we've had so far is December 2023, and the last trailing 12 months tax receipts are looking at about 3.9%. That's very strong. The market expects tax receipts to track very similarly at about 2 to 3%. We're sitting at 3.9%, and strong tax receipts often mean the labor market is in decent shape. And if we actually look at US variables by the NBER in making a recession determination, they look at these 6 variables: real personal income less transfers, non-farm payroll employment, the household employment survey, real consumer spending, real wholesale and retail sales, and industrial production. And we can see that things are looking, I would say, decent, but deteriorating. If you actually have a look at stuff like the non-farm payrolls, real consumer spending, and retail sales, we actually have seen a jump up. We actually have seen a move down in the last 6 months to what it is right now. That's not a good thing. Industrial production has jumped up in a very big way. The household employment survey continues to be a dumpster fire, and real personal income less transfers right now is kind of sitting in the middle, and I would call this data decent. Not good, not great. I wouldn't say it's bad, but if the data does continue to deteriorate, it will end up bad, and we will get that recession call. And that is why we're actually getting rate cuts. However, we should see employment data improve for the rest of 2024. War notices point to lower initial jobless claims in the coming months. War notices normally lead initial claims by about 2 months. They have come down significantly, and that means we should see initial jobless claims track lower, which means less people are filing for unemployment insurance. It probably means more people have jobs, and that lends itself to a stronger consumer, stronger economy in the backdrop of incoming rate cuts. We're going to see if this data comes to par. If it does, that's going to be good. If not, rate cuts should support the underlying economy. But that is in 2 months. What about in the year and now? And the most important data point we have tomorrow, August the 29th, is GDP second quarter revisions. The forecast is to come in at 2.8%, which means there isn't going to be a revision up or down, which tells me if we do get an upside revision, that's going to be very, very healthy for the market. I think the market's going to really like that. But if we get a revision lower, that's not going to be good. Pending home sales can cause volatility, particularly as we get rate cuts. We also want to see if lower mortgage rates, because mortgage rates do lead the Fed funds rate, they have come down. We want to see if consumers are taking advantage of that. And that's going to be very key data for real estate, home builders, as well as financials. We also get initial jobless claims. The median forecast there is 230,000. And then the trade balance, retail inventories, and wholesale inventories. Those are going to be key too. But tomorrow, it's really going to come down to that GDP print and the initial jobless claims figure.